Hi, I'm Jim Crider, and this is the Intentional Living Podcast, where we have conversations about how to use your resources, your time, your money, your talents, for what's important to you in life in an efficient and effective manner. I'm glad you're joining with us today, and I look forward to this journey with you. In this episode, I'm joined with Preston Pysh. Preston is one of my favorites. He's the founder of BuffettBooks.com, the co-founder of the Investors Podcast. That's a podcast network with shows ranging from real estate investing to traditional stock investing, and the show that Preston currently hosts, Bitcoin Fundamentals. Now, Preston and I, in this conversation, we talk through the current fiscal and monetary environment, how in the world we got here, what might be down the line, Scooby-Doo, all sorts of fun stuff. If you want to learn more about Preston, you can follow him on Twitter at PrestonPysh.com, or again, tune into his show over on the Investors Podcast, specifically Bitcoin Fundamentals. All right, well, thanks for being here. Let's get started. All right, Preston Pysh, I appreciate you being here with me today.
Awesome to be here. Awesome to hang out again, Jim.
Yeah, well, I know it's been about a month since we last hung out.
Yeah.
And you were my first podcast guest, so be gracious and patient with me, and I hope this is a great conversation. I'm sure it will be with you here to talk with.
Yep, can't wait.
Well, hey, I'm excited to have you here. I wanted to just have an opportunity to talk with you, and I've listened to you since about 2016. I've heard your voice on double speed for countless hours while doing dishes. It's hard for me to not be scrubbing some dishes right now while talking with you, or helping me not road rage. So I appreciate this opportunity to actually have a dialogue with you. So I'd love to have an opportunity just to talk with you and just go deeper on what you've seen as far as the fiscal, monetary, macroeconomic landscape that's leading up to this strange spot that we're at right now, and what you think possible solutions would be, and what's the end game of where we are right now. So I know that's a lot, a whole can of worms we can unpack, but let's start off with how do we arrive at where we are today?
So I would frame this up in and I've talked a lot about this in Bitcoin community, but for your audience and maybe people that are coming from this from a much more traditional lens, I would first tell them to study Ray Dalio's long-term credit cycle. There's a 30-minute video. There's tons of writing. Ray has published multiple books about this idea of long-term credit cycles and short-term credit cycles. If you have show notes or you have links that people can kind of click on, I would highly recommend for you to have links to Ray's video, How the Economic Machine Works. This is a 30-minute video, and this is the gist of it. Most people that have money to invest, they're accustomed to credit cycles. These boom bust cycles, they typically last, or at least what they have in the last couple decades since we've been alive. You see these 8-year cycles, 8 to 10 year to 5 year, somewhere in that mix, where you go through a big credit event, the stock market melts down, bonds get bid and become really valuable, and then the system gets reset and we go through another cycle. That's what people are accustomed to. But what few people understand is that there's also a much larger credit cycle that we have been a part of, whether you realize it or not, that's been playing out over about 80 years since the Bretton Woods system was stood up in the 1940s. And if you could zoom out, if you wanted to graphically see this long-term credit cycle, it's actually quite simple. You can just go onto Google, type in long-term debt cycle or credit cycle, and then just look at the pictures that come up. And what you're going to see is you're going to see pictures of like the 10-year treasury, and you're going to see the yield on the 10-year treasury go from the 1940s where it was really low, and you're going to see that yield go really high into the 1980s. 1970s, 1980s, where the 10-year peaked out at about 16% in 1981. And then you're going to see the 10-year treasury continue to go down for 40 years straight until we get to COVID. And it pegged it at 0.5% or whatever it got down to. I think it was down to like 50 bips around COVID. on the 10-year treasury specifically. And this, if you weren't just looking at the 10-year treasury, but you were looking at short duration or long duration bonds, you would see this long-term credit cycle that's playing out. Now, why is that important? It's important because like the short-term credit cycles that we're all used to, where things go boom and then things get built again after it goes boom, and everybody goes about their life, and things were bad there for a little bit. It was hard. People were losing jobs, and then all of a sudden they're hiring again, and all these types of activities, and everything reflates. That is going to play out, but on a much grander scale. And we are in that end game. I would argue we're in that end game right now. And so for people that are like looking around qualitatively and saying, what's going wrong with the world? Why does everything feel like it's falling apart? Like everybody seems to be at each other's throats. Like why are all these wars happening? Like it's all happening because of this long-term credit cycle and it transitioning into a new form of money as the settlement layer. So when we look at the second half of this long-term credit cycle, which, my argument is this is from like the 1940s, post Great Depression, World War II, to, I would say, COVID is probably a really good marker of where this is really starting to accelerate for the transition to wherever this is going next. We're obviously of the opinion that it's going towards Bitcoin next. And we'll get to that. So when we look at this, and we're just trying to wrap our heads around like why now, why did COVID, why are you saying that it's COVID? And like, because for the last, since I've been alive, it just seems like the treasury market and the US dollar and the euro and all these other currencies have always been really stable and secure, and everybody just seemed to get along quite fine with no issues. And what I would describe is when your credit markets, when bonds continue, when the yields continue to get compressed and go lower and lower, like they did from 1981 till COVID, what that is actually serving as a bedrock to economic calculation of every asset on the planet. And the reason why is because the value is going up. As those yields are going lower, the value of equity is going higher and higher, reference to that. And if that doesn't make sense, I would strongly encourage a person to just understand the mechanics of bonds and understand how they're priced, and also understand how equity is priced, because stocks are priced based off of a quote unquote risk-free rate of bonds. So the 10-year treasury has really kind of been that benchmark. So generically speaking, if the 10-year treasury was yielding 5%, then stocks should give you a return of, let's just say, 200 basis points higher than that. Stocks should be priced at about a 7% return. Okay. So that would equate to some PE ratio for 7%. 10% is a PE of 10, right? When you go to a PE of 15, the multiples kind of compress and work in a very similar manner. So I would tell a person that your PE ratio, think of it almost like a bond yield. And if the PE ratio is a 10, then that's giving you a 10% return, because it's 1 divided by 10 that gives you the percent. So you take, if it was a PE of 15, you take 1 divided by 15, and that gives you the percent. And that percent needs to be yielding higher than debt, because you have more risk associated with equity. I know I'm getting into kind of the mathematics here a little bit, maybe a little too granular for this bigger overarching sight picture. But the point I'm trying to make with all of this comes back to bonds, particularly US bonds, being the bedrock of economic calculation for the last 40 years. That works until you compress the yields to literally nothing, right? That continues to work as long as you can continue to hide the inflation that everyday participants think is their debasement rate, okay, in the price of getting food or gas or buying a house or things like that. As long as that appears like it's stable and that inflation isn't manifesting itself through debasement, people will continue to pile into this retain their savings. I don't want to say pile into. I would say retain their savings in these debt instruments, which were U.S. Treasuries and bonds from Europe and the UK and Japan and whatnot, because those yields continue to compress and they can continue to become more valuable. What we found after we compressed all of that down to nothing. In fact, we got up to, how high did it go, Jim? You might know. It was like negative $20 billion, or I'm sorry, $1 trillion worth of debt around the world, negative yielding debt.
Yeah. Just absurd.
Is how compressed that spring, because when I'm talking about like this really long term credit cycle, that spring got compressed down to the point where negative $20 trillion worth of debt was issued on the market. Just to kind of quantify how insane that is, that's $20 trillion worth of contracts that guarantee the loss of capital. Guarantee it. Okay. And there were people buying it because their opinion was that they were going to make the rates even more negative, which would have made them more valuable, was the reason you had buyers to the tune of $20 trillion of these instruments.
Preston, right quick, could you talk through if the risk-free return is negative, it seems at that point that equities would just have to essentially return less negative or zero to be a better investment than equities or than this debt. How did that? Yeah. Why does that relate to? It seems that there is a lot of concentration in the market with just a few companies, but it seems like despite, heck, a few years ago when we had these negative interest rates, a lot of the markets were still firing off and doing phenomenally, especially even in backwards times like COVID when everything was shut down. So why do we have this decoupling of risk-free is nothing? I should be happy with cash theoretically, yet equities are still running off in a place of just absolute nonsense.
I love this question. This is actually a pretty advanced question that I think the reason you see so many people in the market today saying, I have no idea where to go or what to do, is because of this question. Because we have now that you're starting to have inflation manifest itself in the prices of everyday things, desirable things. Okay. You're seeing the debt markets chase after a premium to that debasement rate or that inflation rate. Okay. So inflation, let's just say the inflation today is 4 or 5%, or at least that's what they're telling you it is, right? And
hey, did you know that last week Paul Krugman tweeted that we beat inflation? Did you see that? As long as you take out housing and energy and food and transportation, we won. So if all you need is a bunch of televisions, you're in luck.
It's hilarious. So you have the puppeteers that are trying to convince the populace that everything's a-okay, right? When it's totally not. The house is on fire, let me tell you. So, but to your question, why this is so tricky to understand. So you got these inflation rates that are being published. You have credit markets that are trying to sell off to provide some type of premium or yield above that inflation rate. So I would tell people, you got to think of inflation as the benchmark of what you have to outbeat, or that's your hurdle rate, right? So if inflation's 4%, you've seen the bond market sell off to a point that now it's yielding higher than 4% across the entire yield curve. Short duration, long duration is above that 4% rate. So you should be able to keep up with inflation. And I say should be because there's a lot more to this, but just in generic terms, right? I would say you're outpacing that inflation rate by 1%. So you're making your real return is going to be 1%, right? If we're really generically speaking here. And what you would expect is that equities would also be selling off based off of a stable currency and stable market. Equities should also be selling off and providing a PE ratio that exceeds the return you're getting in fixed income, which is around 5%. I would expect it based off of past performance that it would be around like 7% yields in equities to capture the risk premium, right? Which means your PE would have to be way lower than where you're at today, which I think the PE on most is Where's it at, Jim? Like 25 to 30, maybe even 35, depending on the type of company
Yep.
for PE ratios, which for people to understand what that equates to in yield, that's call it a 3% yield. Okay. 3% yield for equities. Now, you might be scratching your head. You're saying, okay, so debt's giving me 5%, fixed income's giving me 5%, inflation's 4%, and equities, which should be the riskiest, is priced at 3%. That doesn't make any sense. And this is to the crux of the question you're asking. So why is that? Why is the world completely upside down like that? It doesn't make any sense, Jim and Preston. Well, here's why. When the currency fails throughout history, there are tons of examples. There's a book called This Time is Different. If you want case study after case study throughout history of a currency failing and what happens during those periods of time, read that book. There's 200 examples or whatever in that book about what is playing out. And the reason that you see equities continuing to hold valuation at really high premiums relative to inflation or the debasement and relative to fixed income is because when the currency fails, what happens is that those debt markets and those credit markets aggressively reprice themselves. I sometimes refer to it as credit markets blowing up. And think about it. The reason why is that credit market is a contract to deliver fiat currency dollars back to that issuer. It's a contract. And the contract's specification of repayment is in dollar terms. So if that dollar is getting debased at a breakneck pace, which it is, since COVID, what was the debasement rate? It was in excess of 25% annual, I think. If we would go from COVID to today, I think it's debasing at 20. According to the M2, if you took the M2 and you looked at the growth rate since COVID, it's getting debased at about a 25% annual debasement rate. Okay, how that influx of fiat enters the economy, it nests itself into areas that some is in the meat of the price of meat. Some of it's in the price of equities. Some of it's in the price of you name it. And so it's not just 25% spread across every single asset and commodity on the planet. It nests itself into different areas. So like if you were looking at real estate in downtown Manhattan or, wherever, you name it, that inflation rate is going to be different than the inflation on the price of gas or the price of corn or the price of an S&P 500 share. Okay, like that debasement enters itself into the economy in all different ways. But if you're going to generically look at what's the hurdle rate, okay, I think that the best way to think about inflation, and there's many of other very smart people out there that would echo this idea, I think the M2 growth rate is probably the real inflation that you need to outpace with respect to money itself. Okay. Mm-hmm. That debasement rate, if we were going to say that that's what we're thinking about as inflation, like real inflation, I would say that if you took the past 10 years and you did a compound annual growth rate on that growth of the M2, you would probably be around like 7 or 8% annualized. So if you're not outperforming that with your savings, I would argue you are losing buying power. So if somebody invested in something and it was growing at 5%, I would say, congratulations, you've underperformed just the debasement rate by 2%. Like you're losing 2% of your buying power based off of what you did with that savings. So when we answer your question, this is the real answer with all of that, and it's important for people to understand all that context so that they can understand what I'm about to say. When the currency melts down, the bonds blow up because they're denominated in said currency of the past system. What isn't specified as the denomination is equity, is stocks. Mm-hmm. Okay, because you have a stock certificate, and that company is performing business and they can elect to be paid in whatever or and retain their savings in anything that they want. Most companies actually retain their savings not in dollars. A lot of them were using treasuries for a very long time when they kept appreciating in value. But those companies can save in marketable securities. They can buy S&P 500 stock. They can buy individual companies and put them, they're non-operational subsidiaries that are just sitting on their balance sheet. But that's how they can save. And so let's say the world would start using Shroot bucks, which is basically the dollar. Um, but let's say the Shroot buck was like really, it didn't debase at all, and it was actually a wonderful currency. That company can choose to denominate their savings and their unit of account inside that company in Shroot bucks if they wanted to. And obviously, what I'm getting at is um, companies, in my opinion, are going to decide to save in the hardest money as we continue to go through this transition of this legacy long term credit cycle into this new financial system. And I think that they're going to choose to do it in a currency that's backed by energy, that is immediately saleable, that has near zero frictional cost to transact, that no entity or government can come in and screw with the amount of units that exist, and has a terminal fixed number of units in it, which is Bitcoin. And I think that's what everybody's going to move to. So if you're looking at this market and you're owning equity, it's all going to be repriced. There's going to be different PE ratios on the other side of this event horizon. But that's why I think you're seeing it already, that equities have a premium to debt, and that's why you're seeing the yields that they're at, and they're kind of holding their value, is because once the eventual transition occurs, and this is why you go read the book, This Time is Different. You'll find that stock markets in their local fiat currency term denomination go parabolic through these events. They go way up.
If you have a money that's infinitely debased, the
That's right.
assets that's being priced against go infinitely up.
That's right. It's the same. I use this example sometimes to help people understand it. If we're playing Monopoly and there's a fixed amount of equity on the board, right? And those are businesses. And let's say the banker comes in and they flood the game with all the money that they're squatting on, and everybody's currency is going straight up. Okay. And there's 5 times as much currency in the game. What's going to happen to the scarce equity on the board?
Yeah,
It's
everyone's
going to
gonna
be
be you're gonna be buying as many houses and hotels as you can because the money's no
That's right.
longer. Yeah, it's you
The
want
only
something
thing
that's finite rather than
That's
this
right.
infinite flood.
That's right. Anything that's scarce in that game is going to get bid. The value is going to go higher. And here's another thing to think about is if you borrowed money from one of the other players to buy the scarce thing, the equity, the stock, right? The person who gets screwed in that deal is the lender, because they're getting paid back remember, they issued the debt when there was 1/5 of the amount of currency in the game. The repayment was in currency terms. Like, the deal that you struck with the other player was, I'm going to pay you back in the monopoly money, and I'm going to pay you back this fixed amount. Okay. Then the banker steps in and they debase the fiat in the game by 5x, but that contract didn't between you and the person that lent you the money didn't change. But what you did with that money is you went and bought scarce equity off the board that now has appreciated in value tremendously. And so that's the game that's being played right now on a global level. And this is why, if I was going to add a little bit more realism to the monopoly example that I just provided, with people basically using debt to buy scarce things, look at who the U.S. is uh, at war with everywhere in the world. It's people that are providing scarce commodity physical things, and what they're trying to shove into their throat as payment are treasuries.
Mm-hmm.
Right? They're saying, You have to use the dollar. You have to use our treasury market as basically the backbone of payment for these physical things that you're delivering. Every enemy that the U.S. has, or Europe or UK, like they're all trying to jam these paper nothings down their throat for physical things, and they're just not having it. And I would argue that that's one of the main reasons you're seeing so much social unrest in the world from a nation, sovereign state level.
Well, there's so many places I want to take this, but we'll camp on that right quick, just where we're at. It's obviously with this where we are with oil right now
Mm-hmm.
is it's interesting. We haven't set ourselves up for an advantageous spot over the last several years. We've essentially
Mm-hmm.
drained our strategic petroleum reserve. Meanwhile, last week, who was it that tweeted that they're going to mandate that we get the price of oil down to what, like $60 a barrel?
Yeah.
I don't know how they think they're going to achieve this. You're trying to get something that has, again, there's a limited supply, and we don't right now we don't have access to that much of that limited supply. Yet we're mandating, or supposedly going to mandate, that we get it for a price when
Mm-hmm.
I would argue that a lot of other countries are starting to lose trust in the U.S. dollar.
Mm-hmm.
So let's just go there right quick. What are your thoughts on oil? Like, will we be able to get $60 a barrel? Like, how's that going to happen? Or like, I,
Well,
I
the way
I
that
don't know how to even process that.
Well, the way the government would try to do it, and just for people to, if you think we're operating in free and open markets, we totally aren't, like not even close. And I could go into like the backstop facility and how basically yield curve control has been happening for banks since they stood up that facility with the Silicon Valley Bank and all this other stuff to kind of prove my point of like why we are not actually operating in free and open markets, which manipulates the cost of capital, blah blah blah, right? But to your question about oil, if the government really wanted to try to keep the price down, they could just print a bunch of their shroot bucks. They could go and if and this is becoming more of an if as the days go by, if they can find somebody to sell them oil, they don't care about the price because they're just printing the shroot bucks, right? If they get the oil for $140 a barrel, they can just print the shroot bucks, shove it into the hands of the person willing to accept the shroot bucks, and then they get the oil, and then they drop it into the market through the SPR program to flood the market to try to push the price down to $60 is the play. So they're trying to lever the shroot bucks to create a false sense of price action in a physical market, and that is a total fool's errand. Now, what they think they can do, like if you're going to jump into the mind of a person in government that's trying to play this game, what they're trying to do is they're trying to create a recession through so much pain, interest rate pain, that um, that they suck the demand for oil out of the market, which would also drop the price. And if they can do all of this through interest rates before they run out of oil to put into the market, then they get away with it, or at least they think they get away with it. There's all other types of maturation that kind of pops out of all these sinister market manipulation type activities that we're not even talking about, right? But in that short term window, if we were analyzing it in that short term window, if they can do all of that before they run out of physical oil or a person willing to give it to them, then they kind of get away with it in the short term, at least from like the psychology of the global or the citizens of that nation state. But boy, what a game to play and what dice to roll, because if they do run out of the oil, which look at the SPR, the Strategic Petroleum Reserve right now, and I'm seeing it's tapped, right? It's tapped. So if we don't get the demand suffocation that naturally comes through a recession, boy, it's going to get fascinating, and you would see the price of oil just totally rip. And now think about the ramifications of that into the treasury market, because the treasury market is moving based off of the expectation of inflation itself. So yeah, man, we're in the end game. We are definitely where we're at in the end game, and how long that end game lasts, I don't know, but I think we're definitely in it, and we're probably in the start of it. But I don't know how long it takes to play out. And I think that for somebody listening to this, if that idea like really makes you raise an eyebrow, like what the heck is this guy talking about? I would strongly encourage you do your own research and dig into this a whole lot more, because for me this is just matter of fact. Like this isn't even like a question of whether this is actually we're in this end game, in this transition to a new system. We are very much in that. But if that's a shocking idea to you, go find somebody else and dig into this a whole lot more. And I would again go back to the Ray Dalio video, because he gives such a great overview of the beautiful deleveraging part there near the end. Maybe he's a little delusional as to like how these systems transition, but in general, the premise and the thesis is very strong and important for people to understand.
You're seeing so many pieces lining up that would be indicative of this end game situation. Even like again the SPR. You have the BRICS nations. You talked if we could find someone to give our Shroot bucks to. Most people won't even take a Stanley nickel for it. So yeah, and you're for a long time we've been able to shove our debt as a country onto other nations because hey, we were the big person on the block. But now again, you're having other countries starting to rise up and recognize the abuse that we've leveraged over decades, and are going to put their foot down, which is it's frightening. I think it's healthy. I think a really easy way to think through where we're at now is thinking through like a forest fire. So like California, like Southern California, if you live out there, I know a lot of people in Southern California want to think it's like Hawaii. It's just tropical paradise. It's not. It's really quite a desert. And you can plant some palm trees and everything, but it's pretty deserty out there. Anyways, we've created this facade for what we think this atmosphere is like, and then we've built homes on places they shouldn't be built. So we've had this building up of assets in places that aren't very stable. And then with forest fires, there's natural cycles with the burning of brush. And what we've done is we've put homes in places that probably shouldn't be, that's not natural for them. And the moment a spark hits, we put it out. When the healthy thing to do over the long term will allow some of that underbrush to be burnt up. But we've allowed for anytime we see the smallest spark, we stomp it out with our big foot. And then over time, we just had this building up of pine needles. Now we have this society that's built around feet and feet of pine needles and leaves and undergrowth. And it's eventually a spark will hit that we can't, with our giant foot, come in and put out. And unfortunately, we've built so many homes around this. So many people's lives are intertwined with this undergrowth, and it's just become natural. It's just part of it seems normal to us. And eventually when it goes up, it's going to be really, most likely, I really hope it's not the case, but it will probably be really painful. But eventually it will lead to a healthier place. And that's a few years ago, Kendra, my wife, she and I went on a hike. We were in Grand Tetons, and there's a beautiful hike. It's right along, it's called Jenny Lake. And on your left, you got this big lake. We're going up to the Grand Tetons and this big waterfall up there. But on the right, there's a whole bunch of beautiful trees that are, you can tell they're not infants anymore, but they're young trees. They're just real vibrant. They look like the healthiest trees in the whole park. Well, the reason it's like that is because several years ago, they had a big fire right there. And that allowed things to get burned out, new nutrients to come in, and the dead and old to be taken away. And that is a natural state that we've suffocated out in a literal sense. Again, we don't like forest fires. It can be damaging to society in the short term, but we've also done that with our situation financially, monetarily, and there's a place of unnatural habitation. Like people now going back to like, where do you put your money if inflation is this high and bonds are negative, and where do you put your dollars? Well, that's led to this monetization or financialization of everything. Suddenly, a few years ago, gosh, it was absurd. During COVID, remember how like used cars were just skyrocketing in price? Everything went up massively. And that's because people are looking for anything to hold their value in. And it's just led to these bizarro world of trying to retain value and worth in something that is relatively scarce, at least scarce compared to this one thing that can just be printed out. And
Hmm.
yeah, it's I don't know what the match will be, or the lightning strike will be. But there will it's inevitable that something will take place that will lead to all this underbrush that we've been accumulating for decades and decades to take a spark and then lead to
Well, Jim, I would argue that the spark has already happened. I would argue that the fire is already raging. No, seriously, like
yeah.
the bond. If you sat at $1 billion bond desk, you have experienced the deepest sell off in the history of the United States since COVID in fixed income. So, like, if you put a dollar amount on how much buying power has been destroyed since COVID in fixed income, it's unfathomable. Like, totally unfathomable. Trillions upon tens of trillions in buying power has been evaporated and eviscerated from the market already. Now, for most people, they don't own that. Most people don't have savings. If you lined up 100 people on the street, most don't even have any savings. So to them, they're not necessarily seeing that. But I would tell you the mat or the spark has already happened. The fire is already raging. When you look at the reaction that we're having from policymakers from the countries that are in debt up to their eyeballs and are flooding the market with more fiat, they're not they're not dropping water on the fire. They're actually dropping gasoline on the fire. Okay, so the process is already underway. It's already left the station. It's nature. Going to your point about like the forest fire, what I think makes this so hard for people to wrap their head around is it's never happened in their lifetime, especially if you're in a developed Western country. It's never happened in your lifetime. So when you're hearing this, you're saying there's no way, because we have as humans we have a cognitive bias that if you've never seen the the black swan, well, the black swan doesn't exist. It's just a myth, right? But this is like extremely obvious. It's just mathematics. And it's well underway. It's well underway, and it's not something to fear. It's something that naturally happens. There is a way to prepare yourself and to protect yourself. You don't have to do anything uh like based on, let's say we're right about Bitcoin and that it becomes this new global settlement layer for the world to settle the exchange value. Based on where the price is today, if you have $1 million net worth, I would argue you really just need about a 1% position size in Bitcoin from that $1 million. So a $10,000 position on $1 million portfolio to preserve the buying power of that portfolio based on the math. And I think I'm not being, I think that's a pretty conservative estimate, is like just a 1% position. So like people that are fearing this or saying, oh my God, like, sure, there's going to be social unrest with that. There always is. Just like in the forest fire, like, hey, there's things that are burning. Like, you got to get away. You got to be lean. You got to be agile. Um, but you also have to have some type. I would argue you really need to have some type of position size to preserve your buying power. The other thing that we've already talked about that's really counterintuitive is if you don't like Bitcoin, or you don't think that it's going to be that as we migrate to a new system, well, the only thing other that you're going to be able to really kind of preserve your buying power is in equities. And you're going to have to own high quality equity that you think is going to continue to be competitive on the other side of this event horizon, because you definitely can't preserve it in debt because it's blowing up.
I was gonna. So a moment ago, you're talking about just the black swan, how we haven't experienced it, and there's a money manager that I run into quite often, and he in town, and I remember talking with him about probably like two or so years ago, 2.5 years ago, and I overheard him in a conversation with a client. He was at a coffee shop talking about their allocation, their bond and stock allocation. And I pulled him aside afterwards and was curious. And And he said all of his clients are sitting in about 80% bonds, 20% stock portfolio. And I asked him, isn't this frightening for you? One, how are you achieving yield right now in this environment with such low rates? And two, what happens when the Fed pivots and starts raising rates? He said, hey, look here, son. I've been doing this since 1982, and we've only made money. And it's this
What an egotistical
entrenched.
response. Yeah, what an egotistical response. Um, and ironic that he said 82, right? Because
It
going
was
back to,
perfect.
yeah, me going back to talking about like how this long-term credit cycle has played out since 81, you could have been a ham sandwich and you would have crushed your performance if you just had a significant allocation to long-term bonds through that entire 40-year period of time. Because it was a massive 40-year bull cycle for long duration bonds. So yeah, and his comment like literally marked the peak, the low point in yields, but the peak in price. And boy, if something goes up for 40 years straight, which long duration bonds did, what do you think the correction on that's going to look like?
What, actually, I am curious. So I saw him recently, and he mentioned I asked him how his portfolio is doing. He mentioned they've mostly shifted to uh, investment grade debt and trying to get some higher yield. And to me, that seems quite risky. Seems like you're trying to pick up pennies in front of a steamroller. But I am curious. I meant to ask you this in Telluride. I'm curious your thoughts. I'm under the inclination that the Fed, man, I want to go so many places. The Fed's obviously trying to bring pain. I think
Mm-hmm.
that's writing is on the wall there. I don't think the
Mm-hmm.
market and the economy has reacted as much as they would like to see. So I think they're going to keep putting their thumb down to
Mm-hmm.
bring more pain. But we have to keep in mind, next fall it's a voting year, an election year, and I think they'll keep their thumb on the pain for a bit. But I would expect for them to pivot probably around, I don't know, March, April is my guess. I'm probably way off here, but that's
I
my
think they're
guess.
already trying to pivot. I think they're trying to pivot right now. I mean, you had what multiple Fed officials every single day for the last like 2 weeks come out and try to talk this thing down, like that we're
It's all
done
mind
raising.
games.
Yeah, yeah. I think they're already in pivot mode. And what's interesting is as because anytime they've done that in the past, you would have saw bonds just bidding like crazy and the yields coming down off of that news of a dozen and a half Fed officials coming out and pumping this narrative that we're pausing, we're pausing, we're pausing. Um, you didn't see that. You didn't see that at all. In fact, you saw the bond market rage into a further sell off as they're saying, we're done, we're done. Why? Why? Well, it's because people can actually do the math and they can see that they've got to flood the system with more printing at this point in time, and those yields continue to go higher and higher, and the prices continue to go lower and lower. So they're
That was
already trying to pivot, Jim.
my my next question was going to be actually related to that. When the if we follow normal bond values in interest rates, we would say that all right, the Fed pivots, interest rates begin dropping, so therefore existing bond values theoretically would go up.
Hmm.
Do you think that's the case, or is there just lack of trust in the system and a realization of the value of the underlying return of payment is just people are starting to wake up to this, so we won't see that seesaw go the other way as interest rates start to drop again, or should we see just a normal, oh yeah, interest rates go back down, therefore bond values, like, should you be looking to buy the long duration stuff as they start to pivot? What are your thoughts there?
So so if you think that we are at peak yield and that the bond market is going to go into a bull cycle for the rest of the year, obviously you want to own duration, right? Because you make more money on the move. But today, right now, the 3 month is offering you 5.46%. Okay. The 30-year is offering you 5%. So you're getting approximately another 40 bips by owning 3-month money with, and this is really important, the optionality to plug it into anything that you think is going to provide more value into the future, versus a gamble that you're perfectly timing the bottom of the bond market, and you're going effectively levered long because you're using the duration to get an outsized performance, that right now that it is the bottom of this bond sell off, right? And that the 30-year, even though it's giving you less yield, and you can change your mind 3 months from now, okay? You can change your minds 3 months from now, Jim, like, and collect 5.46 annualized as you wait 3 months. So, like, I guess the question I throw back to anybody that's buying long duration right now, I would say, wow, you really are that good, huh? Your ability to pluck out the timing is so perfect. You can't even squat for 3 months and collect a 5.46% return because you're that good. Like, it's ego. Like, it's somebody stepping into this right now and buying long duration. And you know what? They could be dead right. But boy, like, I'm sorry, like, everything that I'm looking at from a geopolitical backdrop right now in this market, and I'm not even going to say like the wars and this. I mean, it was just like Biden, like, you know what? We're just going to pop out another 100 billion to these other countries in the world with nobody in Congress voting for anything. We're just going to throw this 100 billion their way. If you're in credit markets and you're buying the 30-year like long at this point, like, I don't, I can't understand it for the life of me. For the life of me. That's why I think it's gonna. I think you're totally nuts. My personal opinion.
It's funny where we're at though. I mean, going back, so you and I both, I think, would agree that the end game for this would be Bitcoin. I think it's the most likely result. But there's so much argument against that, and it's mostly by the entrenched players here. And
Yeah.
as we're talking, I have a bunch of young kids, so I think in their terms a lot of times. So what I'm picturing with this is I feel like we're living in an episode of Scooby Doo, and in Scooby Doo, everyone's the same. It's every
Mhm.
episode's the same. What happens? They're driving along, and they break down in a small town, and there's this person. You always, as an adult, you know who the bad person is. It's the person
Mhm.
who is trying to not have some sort of change or inconvenience in their life. It's Old Man Jenkins the whole time, because Old Man Jenkins has lived in this place. He likes that it's quiet. He likes that he's easily making money and has his life sustained for him or whatever. He's got his old inn that he takes care of. But then suddenly there's this new thing on the block that's making a ruckus, and it's bringing
Those darn
change.
kids. No, it's those
Yeah,
darn kids.
you see, there's so much going on, and suddenly, like, oh well, it's this ghost, it's this villain, and they villainize something, and that's the evil thing, and they paint this picture of this terrible thing the whole time. That's, hey, this is really the problem. We need to get rid of this problem, and everything will be fine again. But then the end of the episode, they finally catch the ghost, and the whole time the bad problem was the one that was the one who's been
Seeking
entrenched
order.
the whole time. Their whole stake here is keeping status quo, and they
Yeah.
wanted to make sure that status quo was kept. But you had these darn kids who came in and revealed, like, oh wait, it was Old Man Jenkins the whole time. And I really feel, in my terrible analogy, I feel like that's where we're at. The U.S. government is sitting here like, oh, it's this and it's that. It's these other things, and these are bad. This is going to boil like Bitcoin's going to boil the oceans, and drug dealers use this thing, and it's quick. Look at that ghost over there. And meanwhile, you have a bunch of goobers on Twitter talking about Bitcoin, and oh wait, I think it's this thing, and we're the darn kids. But I think the people are trying to see the mass is getting pulled off.
Yeah.
And who's it with BlackRock a couple days ago? I mean, stated that he thinks that this current price movement in Bitcoin is, yes, related to the false ETF, but he even indicated he thinks it's also just the fact that people are starting to wake up and realize that Bitcoin might be a relatively safe asset.
They're
And
seeking quality, I think was the quote.
equality, that's it. I think the mask is starting to get pulled off, and people are starting to realize the villain this whole time was not this foreign thing. It was the familiar thing we've been entrenched with the whole time, that's been built up, that it has the most to lose with a changing of tides.
The ultimate fool's errand is seeking order in a universe of disorder and change, right? And what you just described is geriatric incumbents that are living an extremely uh, amazing life, and they have all of the equity and they hold all the buying power. And we can see this in the manifestation of like just the amount that proportion wise, like percentage wise, how much of that buying power is stuffed into the top 1% or tenth of a percent. And what they seek is order in a world that is always changing. And when we look at Bitcoin and we look at what it's changing, you are changing this idea that I can send you gold bars over a wire now, and to custody these gold bars, I don't need a vault. I don't need all this men with guns surrounding the vault. Um, there's no middleman that's taking their cut to transport this, which happens instantaneously. And there's the miners aren't able to drop more supply onto the market when the price rages. And if a person doesn't want to wrap their head around that technology, they're seeking the fool's errand, which is they're seeking order in a world which is constantly changing and improving itself. And it's just that simple. And I actually like the analogy a lot. I think it's hilarious because you're right. That like if you really do dissect those shows, and it is often some old fart that's like seeking order and doesn't want the pesky kids or the noises or whatever, and they're trying to scare them away and use illusions and use fear tactics to prevent chaos or disorder or change. It's really change, prevent change from happening. That's hilarious.
My my last thought for you here would be why do you see Bitcoin as a solution versus just fling to equities? Or gosh, we're only talking about the U.S., right? So why don't we
Yeah.
just go to an international market or an international currency?
I love this.
Why or housing? Like why? There's only a well, there's not, but there's so much land. There's a finite number of houses, sort of. So why not real estate or equities or international markets, currencies or equities or debt or something else? Why this?
Yeah, I love this question. So I think what is a really hard concept for people to think about is what would a PE ratio look like in an economy with a money that's not being debased, like fiat. Okay, and when you think very deeply about that question, you will come to you'll arrive at why I'm like all in on Bitcoin versus stocks. Um,
Which is so bizarre because so much of
that's
your
my
career in your life, like that's how I found you, was talking about
yeah,
the most traditional of investing. Warren
yeah,
Buffett, you buffettbooks.com, like you're the
yeah.
traditional investment guy, but here
Hmm.
you are pivoting so much, not out of hype or just general speculation. There's
Out
something
of
there.
math. It's based
Yeah.
on math. So here's the math. So like when I look at an equity and today it's priced, and obviously I'm talking public, large cap equity. If it's priced at a 30 or somewhere in that ballpark, and we're saying that that's a yield that's equivalent to 3%, what happens when you move to a world and it was compressed to that 3% yield because credit was being compressed to a half a percent. Okay. So that's how it got there. And then as credit's unwinding, equity is staying at these really high premiums because there's nowhere else to go with your buying power, right? So it's continuing to be there. In fact, the multiples might even become higher, which is probably crazy to even think about. But I think that's where it goes next. Is I think the multiples don't go down to 25. I think they actually, in dollar terms, I think they actually start going to like 35 and 40 as debt continues to explode, because there's nowhere else to go to preserve your buying power. And most people aren't going to understand Bitcoin until you're like at a price in excess of $1 million per Bitcoin. And then they're gonna have to understand it, or have to learn it. And then that's when it really starts to get interesting, because then you're going to be looking at what's the value of the equity in Bitcoin terms. So you have to come to, well, what in this new world is going to be the risk-free rate? I think the risk-free rate is going to be lightning channel capacity, and how much a person. So if a person has Bitcoin, they can take those Bitcoin, they still hold the keys, they can open channels. I think all this is going to be turnkey for a person that's squatting on Bitcoin. They're going to be open channels on layer 2 for immediate payment settlement, and you're going to collect fees for that routing. I think that is going to be the new risk-free rate, because what's so interesting about that is you're still holding the keys. What in the history of humanity have you been able to hold the keys while the underlying asset or physical asset is being routed back and forth? I would equate this, if people are trying to wrap their head around it. Think about, like, if I had gold bars and I wanted to open up an IOU network with you, Jim. I can do that, but the gold bars are still sitting in my vault, and I still hold the key to the vault, but we can still settle them back and forth amongst each other. And if there's another person, a third person, I can open a channel with them, and they can basically use these gold bars that continue to be in my vault. It's almost akin to quantum mechanics, is what I would describe this. It's almost like I have a gold bar that's like that can be in multiple places at once. Is how a person can maybe wrap their head around this. And with that, you've de-risked me, or me lending it out, right? Because I'm not lending it out. I still hold the keys, and nobody else does, right? So that's what makes this really fascinating. That's why I think it'll be the new risk-free rate. Now, what percent fee am I going to be able to collect on an annualized basis for, let's say, 10 Bitcoin that would be in a vault? Because whatever that percent is in fee routing, I think is your new risk-free rate. Then you have to think, the next thing that I would say that is going to be a different concept than what most are accustomed to is, how much of a premium above that risk-free rate is equity worth for the price. So, like, let's use some generic numbers here. Let's say that the routing fees for this Lightning network is 3%. Historically, in this fiat world, we would slap 200 basis points above that and say that that's an appropriate risk premium for equity, which would mean 5, which would mean a PE of 20 for equity. I don't think that that's going to be enough, personally. I think it's going to have to be higher than that, and I think it might even be aggressively higher than that. And so, I'm just ballparking it here, because when I look at my own personal Bitcoin, I know what I would be willing to part with it for, and what yield I would have to be collecting on it for the risk that's associated with owning equity and their ability to produce future free cash flows. I think that number is like maybe 10, a PE of 10, which is a return of 10%. And it might even, and obviously it's business dependent, and the prospects of that business and its competitive moat and blah, blah, blah. But I think that you're going to, and another thing that I think makes this really hard to wrap our head around is, like, what does AI introduce? Because I think that that's kind of a landmark technology that's way different than anything we've experienced in our lifetimes. And where that's going and the pace that it's going is going to really change things a lot as well. But going back to the initial question and why I'm saying all this, there is a point. Is if the PE today is 30, and I think the PE is going to 40, and it's just ridiculously out of control versus the free cash flows that it's kicking off and the risk that's associated with that. When I reprice it in Bitcoin terms, the prices have to be drastically different than where they're at right now. And for how much I think Bitcoin's going to appreciate in value between now and whatever that moment is in the future, there's no way equity can compete with that after it's repriced in Bitcoin terms. Like, not even remotely. Like 80% lower than where it's at right now would pique my interest.
Well, it's amazing. It should, again, going back to the wildfire analogy, like this should bring health and equilibrium back. It might bring some pain to get there, but it should
Mhm.
bring health back to an investing standpoint. Right now,
Mhm.
most people are not investing. We're buying the market. Well, why are we buying the market? Is it because you think that these companies are actually valuable and they have opportunity for risk adjusted return that makes sense? It's primarily speculation. Again, I live in this weird dichotomous world of like Bitcoin maxi crazy people and financial planner CFP,
Yeah,
and
yeah.
almost all of them, most financial
Well,
planners bury their heads in the sand to anything macroeconomic. And the moment you mention anything about macroeconomics or fiscal or monetary policy, they say that you're trying to time the market or whatever,
yeah.
versus living in reality. And there's this place of like, look, just buy the index. That's the safest thing to do. But again, I would argue, is that safe, or is that just what the masses are doing? And why is that perceived as being safe? And there's so many weird things there when it comes to investing. And ideally, again, like this comes to this financial or monetization of everything, and these indexes are no longer used as investing. Oh, does this make sense as an investment? It's basically a savings tool. You just got to do something out of desperation, try to at least reach, if not try to moderately outperform inflation. And the
Mhm.
implications of having a money that's not debased is astounding. Like one of the hardest things I think is, especially when interest rates were nothing, was, hey, Jim, we want to buy, like a few years ago, I hated this question. Hey, Jim, we want to buy a house in 1 or 2 years. What should we do with our money between now and then? It's like, well, golly, like, what do you keep it in cash? Like where I live in New Braunfels, Texas, little town in Austin, San Antonio area. A few years ago, I mean, houses went up by 20%, and then my house appreciated by 33% in 1 year, and then about 20% and 10%. Like, so if you
Mhm.
keep it in cash, I just lost 33% purchasing power on my home in 2022. Do you
Mhm.
put it in bonds? Do you put in, at that point, money markets were yielding nothing? Do you put in
Mhm.
equities and risk a pullback in the markets? Where do you
Mhm.
park this? That's a terrible thing that we have to speculate on. Again, this is not because our house is becoming that more valuable. Are that more people moving to New Braunfels that it's 33% more valuable? Or is it the dollar that we're denominating these things in is becoming worth less? When
Bingo.
we introduce a money that cannot be manipulated, suddenly the communication methods, again, money is just simply a means of communicating, storing, and transferring value across space and
Energy.
time.
Yeah.
So the
Yeah.
moment we remove this hijacking of communication, we're able to actually sit here and have a better dialogue. Okay, well, I can look, Jim, I want to buy a house in a year. It's like, okay, well, how much do you think New Braunfels is going to go by? And like, yeah, there's some underlying things like what's wood going to do? Like, is there going to be a big forest fire that causes all the wood to be depleted and suddenly wood's going to cost a lot? Like, we could probably get a better idea. Like, all right, like we think that housing, because the amount of people moving to this area, houses will go up by X amount most likely. But we're not sitting here trying to speculate on what's going to happen with our monetary policy over the next 2 years. It'll make it just put it in, keep it in money
Mhm.
itself versus, again, that's, gosh, there's so much to be, so many questions being begged there. Like, what is money? What are good stores of value? Why is our money suddenly not a good store of value? That seems bizarre, that money itself is a terrible store of value. And I think most people, even the people who don't think about this at all, are starting to recognize that, wow, the dollar's a bad store of value right now, which doesn't make any sense. So
Mhm.
yeah, it is really fun to think through the implications of having money that can't be hijacked by a centralized party or debased, on a, especially at someone's whim, and
Mhm.
the impacts it'll have on investing, and the need to speculate is fantastic. I think it'll be great for
Mhm.
civilization.
Yeah. people just need to think that there's going to be things as we go through this big event horizon that we've been talking about. There's going to be things that perform best, and there's going to be things that perform horrible, and then there's going to be a whole multitude of things in between. It's a vector of many different arrays. And for me, I just want to own the best performing thing. And when I think of, if I was going to just generically quantify things for folks, it would be, Bitcoin is going to outperform everything. Then equities are in there next. And then, commodities could actually outperform some equities, and it could then underperform. And it's going to be very volatile in between. And it's really hard to do that because you're using it through futures. And then there's a huge, so I think for most people, and a lot of it's timing and the frequency of that performance, outperformance and underperformance is a very tight frequency. And so that's really challenging for people to navigate. But those are going to be in there with equities, and sometimes it'll be better and sometimes it'll be worse. And then you have real estates in there, which I kind of treat like equity as well. And that's so dependent on location, uh, the growth in that location, the politics in that location. And so speaking to that is a little difficult as well because it's very nuanced. But think of it like anything else. If it's scarce and desirable, it should probably perform quite well. And if it's not scarce and not desirable, and there's not some type of local ecosystem that's fueling growth, making that land and that property more valuable, well, then it's going to suck. And go back to use Monopoly if you want to understand which properties do well and which ones don't. And then at the very bottom, at the very, very bottom, is going to be long duration debt. Short duration debt might be actually not a bad place to sit here and there as you're trying to navigate this volatile storm. But I would say very short duration, like under a year type duration. So like that's how people need to think about this. And it's all about the preservation of your buying power. And if you select and you have the right composition of this to navigate it based off of your appetite of volatility, because I know that's a huge, for me, it's not a big deal. I like the volatility doesn't scare me. When I feel like I actually understand something, I actually prefer the volatility. But I know a lot of people aren't like that. And a lot of it comes down to just their understanding and their conviction of what they own is why they can't tolerate a lot of volatility. And so they have to come up with whatever composition of all these different types of asset classes as they can to allow them to navigate it and still sleep well at night based off of what they feel like they know and don't know. So I would kind of leave it there for them. And going back to the comment that I said earlier, where we're at right now in this event horizon, like you don't really have to have a whole lot on this to protect yourself from what's about to happen. And this is going to be very difficult for people to comprehend. But the further we go across this event horizon and into this new world that we're moving towards, as the price of Bitcoin runs higher and higher, when the price is at 500,000, I think this is going to have to compose about 10% of their overall portfolio value in dollar terms. Okay. When it goes to a million, it's going to have to be twice as much as that. It's 20% of their portfolio will have to be in Bitcoin at that point to preserve the portfolio value. Okay. So
Well, you think through, let's see, like the German marks. At first, it's like, all right, like if you think, I mean, obviously that happens at a parabolic rate, but up front, like, all right, you just have a fraction of your money kept in U.S. dollars at the time. We're talking about early 20th century, just a little bit in the US dollar and mostly in German marks. But then as it went off, like suddenly if you have 99% of your money in German marks and 1% of the US dollar, you just lost 99% of your purchasing power. So suddenly as this switch takes place, yeah, there is more risk associated with owning the legacy asset itself. And so how do you navigate these weightings of portfolio?
This is what's going to be really, really, really difficult for people because they're going to be looking at a chart And remember, you got to remove your brain and put their brain in there. They're going to be looking at a chart that looks like a tulip Ponzi, and they're going to be told, buy this imaginary Mario coin that we have no idea who invented it, because this is how they're looking at it, right? You and I don't look at it that we know it's backed by energy and all the hashing, and like we know all that, but they're not going to know. The everyday person off the street isn't going to understand that. All they're going to know is that there's this imaginary coin that somehow floats around on the internet that we have no idea who invented it, and it's gone from 500,000 to 1,000,000 in the past 4 months or 6 months or whatever, and everybody's telling me I need to buy it right now. And it's going to feel like a total trap to a lot of people, and they're going to continue to sit on their hands. And the crazy part is that person at 1,000,000 is going to have 20% of their life savings or buying power in that thing at that moment in time. And today, where people sit, they only need to have 1% to have the same protection. So why I say that is, don't go buy it because I'm telling you to buy it, or that somebody, because I'm not. I'm telling you, do your homework, do your research now. The only way you're going to be able to actually handle what's about to come is through knowledge. And nobody can perform that work for you other than yourself. So go out and do the work.
Yeah. Knowledge builds conviction, and conviction builds strong hands. So we've got to be based in knowledge. Otherwise, you're going to get shook out. So, well, Preston, thanks for taking time and talking with me. I appreciate it. That was a lot of fun.
It was a blast, and thanks for having me.
Hey, thanks for listening to the Intentional Living Podcast. Now, today's show is simply entertainment and educational in nature. Do not take this as tax, legal, or investment advice. If you are looking for tax, legal, or investment advice, you should go talk with a tax, legal, and or investment advisor. But again, this content is simply educational and entertainment purposes. Thanks again for listening. We look forward to you joining us on the next episode.